The 5-year rule for the IRA is probably one of the most important advantages we have to retire early. What you probably didn't know is that you can actually withdraw from your traditional 401k, TSP, 403b, 457, or traditional IRA early, way before you turn 59 and a half, tax-free and penalty-free. Yes, you heard that correctly. The 5-year rule with the IRA is a trick that many people on their FIRE journey use to gain access to their retirement accounts, but with certain criteria. So first, you need to know what a 5-year rule is. During your FIRE journey, you should have 2 accounts, a traditional IRA and a Roth IRA. You're gonna have 2 separate account numbers for each of your IRA account because one is in pre-tax dollars and the other one is in after-tax dollars. Now, unless you're a high income earner doing a backdoor Roth IRA and you have an existing balance on your traditional IRA, then you might have a combination of both pre-tax and post-tax dollars in your traditional IRA. I encourage you to watch this video about the backdoor Roth IRA to understand that part of the process. Let's start with the Roth IRA. The 5-year clock starts the day you start making contributions to your Roth IRA. It's important to open and contribute to your Roth IRA as soon as possible, especially if you're in your late 50s, because you're required to have your Roth IRA open for at least 5 years to make tax-free and penalty withdrawals regardless of your age, even if you're 59 and a half. The common misconception is that if you're 59 and a half, then you can make the Roth IRA withdrawal tax-free, but the reality is that you have to have your account open for 5 years. So basically, this is how it works. If you're over the age of 59 and a half and you've had your Roth IRA open for at least 5 years, you don't pay any taxes or penalties on the earnings and interest that accrue inside your Roth IRA. If you're over the age of 59 and a half and you've had your Roth IRA open for less than 5 years, you don't pay any penalties, but you will pay taxes on the earnings and interest. If you're under the age of 59 and a half, then you will pay taxes and penalties on the earnings and interest. But there are also exceptions to the Roth IRA withdrawal rules, and you can check out this video linked in the description below. And the 5-year clock starts ticking on January 1st of the same year you made your first contribution to the Roth IRA. So if you made your first contribution on, let's say, December 31st, 2023, you get to count the entire year of 2023 toward the 5-year rule. And I want you to remember this rule because it'll tie to many other things I'm about to reveal, especially with the early retirement strategy. Another common misconception about the Roth IRA is that if you put money in your Roth IRA, you can't touch any of it. In fact, you can withdraw your contributions at any time tax-free and penalty-free because you already pay taxes on them and the government can't tax you again. So what you contribute to your Roth IRA does not count towards the 5-year clock, but the interest and earnings that accrue inside your Roth IRA, as well as any conversion you make from the pre-tax dollars or a pre-tax account, will need to abide by the 5-year rule. And speaking of the conversion, the 5-year clock also applies to any conversions you make from traditional IRA to a Roth IRA. But before I get into any of that, I want to let you know that I'm launching a new live stream program on my channel, which will include live Q&As, group coaching sessions, and private coaching sessions about the FIRE movement, stock market, real estate, and any current events in the world. With the private membership program, you'll have access to my private Facebook group and group coaching sessions to discuss your financial independence journey. You can check out my YouTube channel for more information about the private membership program. You can also schedule a free one-on-one 20-minute financial coaching session by visiting firesightchat.com/coaching to discuss your personal finances. So anyway, the 5-year conversion applies anytime you move money from your traditional IRA to a Roth IRA. It is a conversion of your pre-tax dollars in your traditional IRA to post-tax dollars in your Roth IRA. So if you make an IRA conversion in the year 2023, you will owe income taxes for that conversion in the tax year 2023 with the tax deadline in 2024. What's awesome is that the conversion you made can be withdrawn tax-free and penalty-free if you wait 5 years. And let me give you an example. So let's just say I have $10,000 I want to convert from my traditional IRA to my Roth IRA in June 2023. It doesn't matter when I make the conversion in 2023 because the 5-year rule starts on January 1st, 2023. So if I decide to make a conversion in 2023, 2024, and 2025, the 5-year clock for each of the amounts I convert in these years will start in the same year. So if I convert $10,000 in 2023, then the 5-year clock for that $10,000 starts in 2023. If I convert another $15,000 in 2024, then the 5-year clock for that $15,000 starts in 2024. It makes sense so far, right? But keep in mind that you will owe income taxes every time you make a conversion. So if my wife and I made $150,000 a year in 2023, then my marginal tax rate will be at 22% and my effective tax rate will be at 14%. When I make a $10,000 conversion from my traditional IRA to my Roth IRA, that $10,000 will be taxed at a 22% marginal tax rate or $2,200. So my taxable income is now $160,000 instead of $150,000. I need to keep in mind that I will owe whatever the highest marginal tax rate will be for the conversion I make every single year. You should also write down on a spreadsheet on how much you convert each year. Not every Roth IRA can segregate your contribution, conversion, and earnings. It is crucial to your early retirement strategy, but how do I plan to save taxes on the conversion I make every year? And don't forget to download my financial independence resources, including all the spreadsheets that I just showed you, for absolutely free by visiting firesightchat.com/contact. You should also check out my Fireside Chat shop to check out the books and equipment I use at firesightchat.com/shopping. Now that you understand how to make a conversion, let's take a look at how this strategy can help us gain access to our 401k, TSP 403b, or other employer-sponsored retirement accounts and save taxes at the same time. So if you have just a Roth 401k, Roth TSP, or Roth 403b, the conversion will not work because you can only move your Roth dollars to a Roth IRA. You can't move your Roth dollars back to the pre-tax dollars because you already paid taxes on them. You can't request that refund from Congress. I personally have both traditional and Roth TSP, which is the same concept as the 401k or 403b. And let's say I have $100,000 invested in my traditional 401k and I want to convert $100,000 in my Roth IRA. How it generally works is that I have to quit my job first to move money out of my 401k and then roll that $100,000 into my traditional IRA. That's the first step. The second step would be to convert that $100,000 into my Roth IRA, but I don't want to convert the entire $100,000 into my Roth IRA because then I would pay a lot of taxes on it, right? Let's say I want to break it apart by $20,000 for the next 5 years. I'm also not converting $20,000 for the next 5 years until I quit my job. If I'm strictly living on my capital gains, qualified dividends, and interest, then my taxable income will be a lot lower than my ordinary income tax. And I showed you earlier that making $150,000 a year as a married couple could pay up to 22% in the marginal tax rate. But if I made $150,000 a year in capital gains or dividends during my early retirement, then I only get taxed 15% of $60,750 because the first $89,250 is taxed at 0% for long-term capital gains or qualified dividends. Then my total taxes will only be at $9,112.50 or 6.07% in the effective tax rate. How crazy is that? And the other strategy some early retirees do is strictly living on cash for the first 5 years when they make those conversions, because living on cash in your savings account is not considered taxable income. But when I make that $20,000 in conversion from a traditional IRA to a Roth IRA in the same year, I don't pay any taxes on the $20,000 conversion because my total taxable income is at $20,000 with the standard deduction of $27,700 for the tax year 2023. And that's likely going up every year, adjusted for inflation. But if I decide to convert something like $40,000, then my marginal tax rate only goes up to 10%, which is better than paying 22 or 24% while I'm still actively employed, right? So let's say I have $250,000 saved in cash and I plan to use $50,000 every year for 5 years, then I'm still going to convert $50,000 a year from my traditional IRA to a Roth IRA. And I'm going to use the 2023 tax rates as an example, okay? I would be taxed 10% of $2,236 of that $50,000 in 2023, 2024, 2025, 2026, and 2027. Starting on January 1st, 2028, I can withdraw that $50,000 I converted from my traditional IRA, 401k, or TSP tax-free and penalty-free. So now I'm living on the $50,000 I converted in 2028 when my cash is depleted, and then live on the $50,000 I converted from 2024 to 2028 in 2029, 2030, 2031, and 2032. So not only do I get to maintain the same tax rates throughout my early retirement starting in 2023 because I use cash to pay for my living expenses, but I also get to keep the same tax rates going into 2028 because I already pay taxes on the conversions. So bigger the nest eggs I have in my traditional retirement account would allow me to convert more pre-tax dollars in my early retirement. The most I want to pay is 12% in the marginal tax rate for the conversion I make. And for the tax year 2023, the maximum dollar for the 12% marginal tax rate is $83,550 for couples, or $41,775 for single individuals. Those numbers will go up every year adjusted for inflation. But does this mean that you should contribute all of your money to your traditional account? Not necessarily. I'm still contributing to my Roth accounts because I know how powerful my Roth dollars will grow over the years. Most of my pre-tax dollars came from my employer contributions, employer matches, bonuses, pensions, and other sources of income. And how much I really have in my investment accounts will be revealed in my private group coaching sessions in the future. So I encourage you to check out my private membership program by visiting my YouTube page. And if you want to know more about how to decide on a traditional 401k or a Roth 401k, or how to maximize your investments every year, be sure to check out these two videos. So with that said, I appreciate you watching my video. Don't forget to subscribe. I hope to see you in the next video. Have a good one.